So I wish I knew investing in Tesla way back in 2020 would have made me over 800%, and I regret not investing in one of the top mobile producers in the world, Apple, which is trading over 300% profits when a lot of people were scared of the world ending soon and withdrawing their money because of inflation. I would have turned my $5,000 into $100,000 in less than 5 years. That is why if you stick with me to the end of this video, I will show you how to invest in stocks and make thousands of dollars every month with a trick I'm about to show you. I will also show you why it is so important to invest in stocks now and what stock you need to invest in. Before I begin with this video, I would like to explain what stocks are. Stocks, also known as shares or equities, represent an ownership in a company. So when you buy a stock of a company, for example like Apple, you own a little piece of that company. Companies issue stocks to raise capital for various purposes such as expanding their operations or investing in new projects. Stocks are bought and sold on stock exchanges where investors can trade shares. The price of a stock are usually influenced by various factors including the company's financial performance, economic conditions, industry trends, and overall market sentiment. Then why then do you need to invest in stocks? The primary reason why most people invest in stocks is the potential returns compared to alternatives such as banks. So if I'm able to get high percentages like 10% per year from a stock, why then do I need to save my money in the banks whilst I can get a lot of interest or returns in companies that I believe in? The next reason why you need to invest in stocks is to protect your money from inflation and currency depreciation, especially with countries which have unstable currencies or economic conditions. Stock market returns often significantly outpace the rate of inflation. For example, the long-term inflation rate has run about 3.1 annually since 1913. That compares to a double-digit annual return from stocks. So instead of investing in my country's currency, which is Ghana cedis, I will rather invest in dollars, which will also prevent depreciation of my money. So if I own 100,000 Ghana cedis now, which is around $8,000 to $10,000, I'd rather exchange it for dollars and invest it in stocks in the long run, giving me some percentage on the amount that I'm going to invest, at the same time making sure to protect my money from currency depreciation. So within just 1 year, from 2022 to 2024, my country's currency has made a lot of depreciations against the dollar, which has caused higher inflation in the country. The next reason to invest in stocks is diversification. You can easily build a diversified portfolio across many different industries through stocks. That can help you diversify your overall investment portfolio, which could also include real estate, bonds, and cryptocurrency. The next point is liquidity. Most stocks trade publicly on major stock exchanges, making it easy to buy and sell them. So in the late 90s, before you could acquire a stock, you would need to call a stockbroker before you can purchase a stock from Apple, Google, or any of these companies. But now, with the help of websites and mobile applications, you can easily buy and sell your stocks anytime, anywhere, without a hassle. So if you want to invest in stocks, there are two ways that you can invest your money. The first one is lump sum investing. If you have a lump sum to invest, you can do so at once. A lump sum approach requires you to have a large amount of money to invest. So you can invest $1,000 and leave it to have a significant appreciation in the long term. The second one, which I really love, is dollar cost averaging, which refers to the process of purchasing an investment on a regular schedule. So let's say you decide to invest $100 worth Apple stock priced at $100 per share every month. Let's say we are in February. Then the market goes back the following month, which is March. The price of the same stock falls to $50. Due to dollar cost average, you then buy $100 of the same stock again. Now you get 2 shares instead of 1 share at the price of $50. Then the following month, which is April, the stock rises back to $100 per share again. This means that you've paid $75 for 3 shares instead of $300 for 3 shares in February. That is the average dollar cost. So the $75 is the average dollar cost, which is less than the $100 you bought initially and more than the $50 that has fallen now. With the advantage of dollar cost average, if you sell your shares now, you will make $300 with the 3 shares instead of $150 initial purchase. So that is the benefit of dollar cost average. So with this approach, you can start investing early and take advantage of compound returns. So the best way to invest in stocks is using dollar cost average. So you can buy an amount of shares on schedule. This will help you make a lot of returns, giving you potential in your portfolio. Know that I'm not a financial advisor, and you must research very well before you invest in any stock. I won't guarantee you that you're going to make the same amount that I made or guarantee that you're going to make money fast. However, you can make a significant amount of money investing in the right stocks using the steps that I'm showing you. Investing in stocks involves risk, and stock markets can be volatile. So it is very important for investors to conduct thorough research, diversify their portfolio, and consider their risk tolerance before participating in stock markets. So let's talk about the apps that you can use to invest in stocks. So if you're in the US or Europe, you can use Webull or Robinhood to invest in stocks. You can also use Bamboo if you are in Ghana or Nigeria or any part of Africa. You can use Bamboo app to invest in stocks or ETFs. Before then, don't forget to smash the like button and subscribe to the channel for new videos like this. So the first step to start investing is to open an account with one of these applications. So I'm going to use Bamboo app for this tutorial. You need to register Bamboo with a link in the description below. Download the app from your favorite app store. It can be found on both Play Store and Apple App Store. Then follow the steps to get your account registered. If you want to learn how to register and verify your Bamboo account, make sure to check the link in the description below for a full tutorial on how to make money with the Bamboo app. So after you are done with your registration, the next thing is to add funds to your account. So you can choose any amount. You can start with $20. Then the next thing to do is to choose the stocks that you want to invest in. And before you invest, make sure to do a thorough research in the stocks and the ETFs that you want to invest in. And make sure not to invest in an amount that you can't afford to lose, because the market is always volatile. Only invest in companies that you believe in, and this investment is going to be for a long term, which at the end of the day is going to make you more profit in the long term. So the next thing is to diversify your portfolio across market sectors. Diversification is an investment strategy to manage risk. So instead of investing in only one company, you can invest in multiple companies or ETFs, which is going to save you at a long run in case one of your stock markets crashes. Since you are using diversification, it's going to help you sustain the market. The next point is to use dollar cost average to regularly invest in stocks. This is a great technique for long-term investment. So let's talk about some key factors for evaluating stock market investment. So before you invest in any stock, make sure to take these steps into consideration before you get started. The first one is to consider the company's fundamentals. Look at the metric like revenue growth, profit margins, debt levels, and cash flow. Strong fundamentals suggest a company is financially healthy. The next thing to look into is growth potential. Look for signs that the company is positioned for future growth, like expanding into new markets or releasing new products. You need to also consider the competitive advantage of a company. Look for companies with some edge or uniqueness that allows them to stand out in their industry and fend off competition. This could be proprietary technology, brand power, patents, or distribution networks. Before you consider investing in a stock, you need to also consider the valuation of a company. Consider metrics like price-earning ratio, price-to-book ratio, and price-to-sell ratio. The last but not the least is technical indicators. You need to analyze price and volume patterns to identify trends and signals on a stock price movement. Indicators like moving averages and support or resistance level can aid entry and exit timing. So these are some of the steps that you need to consider before you make a move in your stock investment. Always do your own research before investing, and remember to smash the like button and subscribe to the channel for more videos like this.